I'd like to tell you about a tax break for investors called capital allowances. It's what we use to attract our joint venture partners so that they can get some of the tax that they've paid back from the government, and we'd all like a bit of that. Capital allowances are a tax break usually applied to commercial properties, and this has gone on for years. However, a clarification of detail in the Finance Bill 2012 caused us to look more closely at this tax advantage from the perspective of the properties we let out on a multi-let basis, right the way from 2-bedroom properties to 6-bedroom houses in multiple occupancy, that's HMOs, and on to larger properties with 7 or more people occupying them. The HMRC announced, fairly unexpectedly, a change in their revenue brief 4510. They said, change of guidance, meaning of dwelling house, on the 22nd of October 2010, and it stated, a dwelling house is a building or a part of a building. Its distinctive characteristic is its ability to afford to those who use it the facilities required for day-to-day private domestic existence. It goes on to say, HMRC have concluded that the definition based on the presence of the facilities required for day-to-day private existence is a better everyday description. As usual, HMRC are vague in their clarification of the tax law, and the elements that are considered to be facilities for day-to-day private existence is not clear. HMRC mentions kitchens and lounge areas, but does not mention communal storage and wash facilities. Although we can easily defend the inclusion of storage and access areas, it would be difficult to argue that a bathroom, albeit communal, would not be necessary for day-to-day private domestic existence. So plant and machinery value, the capital allowance, will now be at around 7 to 12% of the property purchase value. Furnished holiday lets and commercial property capital allowances are unaffected by this statement, and so this tax break can still be applied to them in the same way as it has been. So we work with assessors and tax accountants who can assist in this process because it's quite complex. The process is not well known even throughout the accountancy world, and there are several different viewpoints on whether or not this allowance is applicable to residential multi-let properties, and this is why I've teamed up with specialists in this area. And I'm just hoping to bring some tax benefits to those who have HMOs and other multi-let properties. We've made several claims ourselves in this way, and I have many other contacts who've used this process too to make huge savings and claims back from the government in tax already paid and tax yet to be paid. And I'm going to fully outline how this works so that you and your investment partners can make the most of this tax saving or rebate. The process is a bit of a maze, so I'll walk you through it in simple steps. Firstly, which properties are eligible? Number 1, a capital allowance claim can only be submitted once on each property for the same fixtures. This means that if a property is refurbished, there may be claim made against the outgoing furnishings as well as the incoming, as long as this has not been done previously. The property must be let out to 2 or more unrelated households, either under a single or under multiple ASTs, that's Assured Short Hold Tenancy Agreements. The capital allowance relates to the purchase price of the property by the claimant and is not relevant to any increase of price due to inflation or added value because of the works done on the property. The plant and machinery included in the capital allowance claim is in the communal areas of the house and not in the bedrooms or private dwelling areas, and may include the heating systems, fire systems and other fixtures and fittings used by all parties. If any of the previous owners of the property made this capital allowance claim, then this cannot be done again by yourself. In order to work out the amount that can be claimed, a survey will be done on the house by a tax surveyor, and each element written up into the report that is submitted to the HMRC. That's Her Majesty's Revenue and Customs. The amount that is usually claimable is between 7% and 12% of the purchase price of the property. Secondly, the claimant and how the claim works. The claim can only be made by the mortgage holder for the property. If the property is owned unencumbered, then the owner or owners may claim. If there are more than one mortgage holder or owner, then the claim is split evenly. This applies to both freehold and leasehold properties. This applies only to UK taxpayers. When the claim is submitted and agreed, the amount being claimed is taken off the PAYE or tax already paid or due to be paid by the mortgage holder. This means that the claimant needs to have earned sufficient for tax to be payable in that year, or paid in a previous but still open tax year. The amount of the claim is taken off taxable earnings prior to the PAYE being applied. This reduces the amount to be paid for the claimant. The claim is also related to the year of purchase of the property. So if it is purchased in a currently open tax year, this could apply to the previous tax year depending on the date of the claim, then the entire amount can be written off against earnings up to a total of £250,000 of claim in any 1 year. If the claim is more than the claimant has earned in that year, then the amount that can be claimed will be capped at the total amount of earnings. If there is any residual capital allowance to be claimed, then this can be pooled for following tax years using the writing down method. If the claim is made against a property that was bought in a tax year that is now closed, then the allowance is automatically pooled and the writing down method is used to calculate the allowance that can be used. Thirdly, the process. We provide the following to help you make your claim. A free client review to confirm qualification of the property. A client fact-finding interview. A flowchart to track progress and to assist in mitigating any potential negligence scenario. Accountant's guidance notes. Examples of valid replies to Section 19 CPSE. Pre- and post-contract checklist. Example of special conditions for inclusion in commercial contracts. A survey of commercial property or property on instruction. Provision of a fully HMRC compliant report for the claimant. Assistance with report submissions online and by post. A follow-up process if there are any issues with the claim or you need to appeal an adverse decision. There haven't been any adverse decisions to date. If you require a brochure which has further information on this allowance and the pooling process, please submit your details and we'll send this out to you straight away. Let me work an example for you. A property purchased for £200,000 would attract a capital allowance of between 7 to 12%. So let's assume 10% for simplicity. Now 10% of £200,000 is £20,000. So you take this £20,000 off your salary before your tax is paid. If you're a 22% taxpayer, then this will equate to £4,400. And if you're a 40% taxpayer, then the allowance will be £8,000. For a property with a value of £300,000 then, this would be £12,000 tax relief at 40% and £6,600 at 22%. Remember, you can claim up to £250,000 worth of capital allowances in any 1 year, as long as you have this much taxable income to offset it against. So if you bought multiple houses, then this would also apply as long as the rules above are adhered to. So don't delay your claim using this process. If the property is already owned, then you need to make this claim by April 2017. If you are buying and converting to multi-let use, then there's no time limit at the moment, but watch this space. If you are buying a property after April 2014 that has already been used as a multi-let property, then only the previous owner can claim and not yourself. But that owner does have up to April 2017 to make that claim. For an initial discussion about your multi-let and to find out whether or not it's worth claiming your allowance, please call the office on the number below to discuss this with one of our team, and we'll go through the process with you so that you can get the money back from the government or prevent you from having to pay it in the first place. So if you or anybody you know have multi-let properties or HMOs, then please get in touch, because it'd be great if you could get some money back from the government.